everybody. Ben Nelson here, the Everyday Real Estate Investor. Thanks again for tuning in. The Everyday Real Estate Investor podcast. We talk about mindset, strategies, tips and tricks, things like that to be able to start investing or scale your investing, especially focused on those that are busy with other things, busy professionals, busy family people, that have a lot of family stuff going on. Maybe you're raising your kids, but you still want to invest in real estate. Maybe you have a professional career that you really love and spend a lot of time on. You don't want to leave that. Or maybe you have a W-2 that you do want to leave, and that's eventually your goal, but you have to get started part-time before you're able to do that. So that's our focus. We talk about ways to do that. We talk about, and we talk to people that have done that or are doing that and finding success in doing that so that you can take those same things and do it in your own life. So if you want to be involved in real estate and get involved in the real estate investing game or scale your current business, but are trying to figure out ways to do that in your busy schedule, you found the right place. This is where we do that and talk about how to do that. So stay tuned for more, as I continue to build this and form a community, like-minded people and people kind of on the same journey. I'll be continuing to add, community things, ways to connect, tools to download, all those things. So that's all in the works, one thing at a time, but stay tuned for that stuff. So today I wanted to jump into real estate returns and how to look just as a 20,000 foot view. We're not going to get into like super specific numbers today, but just a general idea of what real estate returns are, what to be looking at for real estate returns. Because a lot of times you hear, you get comparisons of the stock market versus real estate. Now, over the last couple of years, real estate's seeing huge appreciation. So, you don't get the same, real estate, it has lower returns than the stock market kind of arguments, at least lately. In the past, you get that argument, hey, the stock market makes, on average, I think it's, 12 to 14% annually, and real estate's historically been 5-6%, the last couple of years, depending on what market you're in, but a lot of the major markets have seen well above that amount. But the reason why this is important is because you can't just look at one piece of your returns and then use that to compare to something else. So number one, whenever you're looking at investor options, what you want to invest your money in, you always want to do compared to what are your other investment options, and so that way you can make the best decision. So that starts with what we talked about a few weeks back with what are you really after in your real estate investment, cash flow, appreciation, those sorts of things. So you got to start there. You have to start with looking at your risk tolerance. All of that stuff is important to look at before you just jump into an investment. And then you got to compare your options, right? So stock market, bonds, real estate, oil and gas, investing in a business. There's all sorts of things that you can invest in. But you have to compare those, and what are the benefits, what are the drawbacks of those things, and then what are the returns that you can get. So again, kind of looking at the real estate versus stock market thing, you can't just take the average annual returns and just take one versus the other. And then going back to I don't remember if it was on a podcast or one of my other videos that I did recently, but I mentioned that real estate is not. There is no the real estate market. I mean, and really to be fair, there's really no the stock market. People talk about the stock market and they're talking in general terms, the big indexes, the Dow Jones, the S&P 500, those things. And same thing with real estate. People talk about real estate here on the news. It's real estate on a national level, right? So, but you have to remember that real estate's very local. The stock market has individual stocks that are going to do better than other individual stocks. Just like that, real estate has individual markets that are going to do better than some, and there's going to be some that are not going to do as well. So you can't just take the real estate market and say what's going on in the real estate market. Now, there are things that on a national or global level affect the entire real estate market. That is for sure is true. So you do have to look at that. Lending and all of that stuff, what's going on in the economy. But you also really have to dial down into your local market and your local, what are you invested in? Is it single family homes, multifamily, industrial? All of these have different markets within them. So But anyway, you could get back to returns. Again, you can't just look at one piece of it, right? You can't just look at appreciation. You can't just look at one piece and compare it to like the stock market. So we're going to break this down. This is going to be a quick breakdown without a lot of numbers, but just to kind of give you an idea of what things you should be looking at when you're trying to figure out your real estate return, so you can make a fair comparison of what you're actually able to do. So I call this, so there's a 4 pieces to real estate return. So you want to be looking at your total return, not just like your cash flow or your appreciation or that. You got to look at the whole thing. So the first thing is cash flow. So not all properties cash flow, especially if you're doing like a value add, if you're doing something that you're repositioning an asset, you're doing a fixer that is going to get more rents later, or it's a multifamily building that's maybe partially vacant. So it might not cash flow at first, but cash flow, you should, in my opinion, from a long-term perspective, I would never go into something personally, and that's a personal investment philosophy thing, but I would never go into something or necessarily advise somebody to go into something that is taking money out of your pocket on a monthly basis. If it's a short-term thing because you're making some changes and eventually it's going to be cash flow positive, that's fine. That's a strategic thing that you're making that decision. But to feed something and have a negative return and be hoping that you can make more money later because of appreciation or something like that, to me is more speculation and not investment. Not only that, your cash flow is how you control the property. So if you're feeding it every month, then you can a lot more easily lose control of that property because you can lose control of the debt. So, but anyway, the cash flow is one piece of it, right? So you're looking at how much are you bringing in versus how much you invested in it. So say you bought a property, put $30,000 down on an annual basis. After debt service and all your expenses and everything, you're bringing in $3,000 a month. That's just for simplicity. That's a 10% return, right? $3,000, you invested $30,000, so that's a 10% return. So that's one piece of the puzzle. The next piece to look at is, we mentioned it earlier, appreciation. So we don't know what the future holds, but obviously we had the 2008 2010 range where the market took a huge turn down, and so that can happen. Historically, real estate has gone up, and there's reasons for that. There's a lot of factors with financing and availability of capital and all of that stuff, but we're in an inflationary environment, and generally speaking, in an inflationary environment, and if you've been paying attention to the news at all, that's a hot button item right now. Inflation's been in the 7.5% range. So most of the time when you have inflation, it does increase the value, quote unquote, of assets, because it takes more dollars to buy that same asset because the dollars are becoming worth less and less. So it's a hedge against inflation, and therefore if it takes more dollars to buy the same asset, then you're going to see that increase in price. So that's one thing and again, you're not saying that real estate there's always cycles in real estate. And again, you got to look at local versus just national, but appreciation is one thing. So if you're if you're making 10% on that cash flow, if it's appreciating 5%, there's another a piece of the puzzle right there. And I'll get back to the appreciation piece in a second, because there's another piece of that you got to look at. But the next part, assuming you're using financing, if you're getting a loan, is amortization. So if you get a loan, it's on an amortization schedule, which means that you have a certain set amount of time that you are paying this loan off. A lot of times it's 30 years. And you are paying, and with every payment, you're paying a little bit of interest and you're paying a little bit of principal. At first you're paying a lot of interest and a little bit of principal. And then as you go, you pay more and more principal and less interest. That's how they're structured. But the bottom line is, every month you're paying that down and you're getting additional equity with that payment. And if it's income property, you're not even the one investing in that, right? So someone else, a tenant, whether that's a single family home and someone's living in it, or it's retail or office or something like that, and you're renting it out to in that way for that use, someone else is working or running a business or something, and when they pay you that rent, you're paying down the loan and you're getting that extra equity every month. And so that needs to be calculated into your return, right? If you pay down on that first example, another $3,000 on your loan that first year, that's another $3,000 added to that $3,000 of cash flow. And so that increases your return. Now it's not a 10% return, it's a 20% return. And you've got $3,000 in cash flow, $3,000 in amortization, debt paid down, more equity. And so that's calculated in as well. And so then, go back to the appreciation thing. If you just take the actual appreciation, well, I don't want to jump ahead to that quite yet. I'm gonna get to that later because I want to touch even more on leverage and the power of leverage. But so cash flow, appreciation, amortization. The fourth thing is depreciation or tax benefits. Depreciation is a specific portion of the tax code and is a great tax benefit. Now, I am not a CPA or a tax advisor. You definitely need to talk to a qualified professional and just make sure that you are able to take advantage of those benefits and know those things going into it. But there is a lot of tax advantages to owning real estate. And there's a lot of times you can take a paper loss. So you're not really experiencing the loss, but you can use that to offset some of your other income and not have to pay taxes on that. So very powerful, a great way to really, you're not taking a loss, but you're able to deduct the loss on your taxes and save on your income taxes. So we'll get into that maybe down the road. I'm not qualified to have that conversation myself. I'll bring on an expert to talk about that so we can really dive into some of those benefits and how you can tap into those, because it's a huge tool. It's a great way to increase your returns. Now, I will say that you don't want to buy something only for the tax benefits. That's not a reason to buy something because the tax code changes all the time. So if something only makes sense because of the tax breaks that you're getting, if the tax code changes, now you have something that doesn't make sense, and it could be an asset that's not producing what it's supposed to be for you. So that should always be an add-on benefit, not the reason to buy something. So, but it's still something that you can calculate into your total returns. Now, jumping back to leverage, just really quick, and we'll talk again. This is another topic we'll talk about more in depth down the road. But I'm a leverage guy. Like you have to use leverage properly. You have to use it in the right way. People are there's a lot of stuff out there that talks about debt negatively. There's guys like Dave Ramsey out there, preaching about paying off all your debt and all that stuff. And for some people that's fine. I'm not like dissing Dave Ramsey or that program or whatever, because he's helped a ton of people get out of debt and everything. But there's a right way and a wrong way to use debt. We're in a society built on debt, and it's how our society works. It's just how it works. And I wish I could remember who said it, but it was on another podcast that I was listening to. This was quite some time back. It was on the Real Estate Guys radio podcast, and they had a guest speaker on, and it's just, I can't remember who it was offhand, but he said that we are not really a capitalist society anymore. We're a creditism. It's not capitalism, because capitalism is saving and then investing. We're a creditism, basically. We're built on credit, get credit, and then buy. So our society is different. It's hard to function without leverage, without buying. So it's something you have to get your mindset around, especially if you've been told debt is bad, and don't get debt. Now, some debt is bad. Bad debt is bad if it's not producing for you, if it's taking money out of your pocket every month, if you're having to feed that and pay interest on it and it's not doing anything for you. That's bad. So I like to refer to debt as, it's very similar to a tool, like a chainsaw, right? If you use a chainsaw properly, it's great. You can cut through, tree branches, you can cut down trees, you can do work in a much shorter amount of time than if you use like a handsaw or something like that. But if you use it improperly, you could cut your arm off, right? So you have to use it properly, and use it in the right way, and responsibly, and then it's a great tool and it can do a lot for you. And so just as a quick example, and this is where, again, going back to the stock market versus real estate thing, when people are just looking at appreciation versus the stock market, if you buy, most people buy real estate with leverage, with a loan. So if you were to say, just take that average 5% real estate return, if you're going to take a really conservative return, like with appreciation, if you have bought that property, so say it was a $400,000 property and you put 10% down, okay, that's $40,000 that you put as a down payment. Now, if the market appreciates 5%, you get that 5% return on the entire value of the property, right? So you get the 5% appreciation is on the $400,000. So that that $400,000 property is now worth $420,000. Well, you only put $40,000 down, so your return's not the $20,000 against the $400,000 property. That's the appreciation amount. But your return is based on your investment in the property. So if you've only put $40,000 down, $40,000 down, and you gain $20,000 in appreciation, that's not a 5% return, that's a 50% return on your investment. So that's the power of leverage, is that it can really magnify your returns because you're getting appreciation. That appreciation is on the entire asset, not just on the amount that you have invested into it. Now, the flip side of that is, if you have 10% down and the market goes down 10%, if it goes up 10%, great, you made 100% return. If it goes down 10%, you've lost your entire investment, right? But the thing is you still, if you buy right, even in that scenario, you still own an asset, you still are getting it paid off by someone else, and you are still getting the tax benefits, and you're still getting the cash flow. So think long term, especially as people are questioning where we're at in the market. If there was a dip, if you're investing for the long term, as long as you buy right, and as long as you buy something that cash flows and is going to give you those other benefits and you can hold on to long term, the market's going to come back at some point, and you're going to get that appreciation. It may take a little bit longer than your initial plan, but it will happen, and you're going to continue to get those other benefits in the meantime. So those are the four main things to be looking at for your total return when you're looking at real estate investment options. So hopefully that's helpful to you guys. I do have a report that I put together that kind of goes a little bit more detail on these and gives some examples and that sort of thing. So if you go to theeverydayrealestateinvestor.net. I don't have a full website built out yet, but it will go to my podcast page on my personal website. And then from there, there's a resources tab where you can get that report and download that and read a little bit further. So if you want to get a little bit more information on how these things work and some examples and that sort of thing, go to theeverydayrealestateinvestor.net and go to the resources tab, and there should be a spot there to download the report for the 4 pieces to real estate return. So until next time, thanks again for listening. Stay tuned. We're going to dive deeper into these specific topics. I've got some great guests coming up. We're going to talk about some great strategies to get started in real estate, some ways to leverage your current business and scale that. And we're going to talk a little bit more about the market and what's going on in the market and the finance world and all that stuff, because there's a lot going on right now. So don't miss out. Keep tuning in. Let everybody else know about the podcast so we can continue this journey forward together. We can build the community and we can all help each other to succeed. Until next time, Ben Nelson, the Everyday Real Estate Investor, signing out.